Every headline right now is focused on the immediate geopolitical explosion. Japan just blocked key chip exports. China is retaliating. The consensus view is that this chaos forces the Federal Reserve's hand. They have no choice but to print money to stabilize the debt markets and prevent a complete liquidity collapse. But that's the paper game. It's the noise. There is a far more fundamental and structural event brewing right now that makes all those geopolitical headlines irrelevant. Wall Street is currently valuing a specific, globally critical element, as if it were still a simple industrial byproduct. They are trading a false price based on a decade-old understanding of chemistry, and that colossal mistake is about to cost the world economy $1 trillion. They are lying to you, because they haven't done the basic math on the physics of the energy transition. The core of this impending collapse lies in a material fact that energy experts have tried to ignore for a decade. The ion lithium battery has hit a wall. We are stuck. You cannot improve it fundamentally. The barrier is physical. It's called the dendrite problem. Dendrites are microscopic, spiky growths that occur when you charge a lithium battery too fast, or try to pack too much energy density into it. They are why your electric vehicle has limited range. They are why fast charging still takes 30 minutes. And most critically, dendrites are why lithium-ion batteries catch fire. They pierce the separator, causing thermal runaway. The global push for net zero requires longer range, safer, and faster charging batteries. But the current chemistry is inherently fatal to that goal. For years, the industry's holy grail has been the solid-state battery, or SSB. Imagine a power cell that is not flammable, charges in 10 minutes, and offers double the range. The breakthrough has always been about how to replace the flammable liquid electrolyte with a solid ceramic or polymer, while simultaneously stopping the growth of those deadly dendrites. Wall Street has assumed this problem would be solved by some obscure, newly engineered molecule. They were wrong. The solution has been hiding in plain sight, a metal that has been foundational to finance and technology for 5,000 years. The element critical that resolves the dendrite issue acting as a high-conductivity structural anode component is silver, not as a trace element, but as a critical part of the battery's fundamental DNA. This is not about silver being a minor component in wiring harnesses or small electronic circuits anymore. This is a paradigm shift. In the older chemistry, silver was a statistical spec, maybe a few grams per unit. In the new, necessary solid-state technology, it moves from a passive industrial input to an active, structural ingredient required in substantial volume, potentially dozens, perhaps even hundreds of grams per vehicle. We are moving from trace consumption to structural consumption. Wall Street, stuck on its old models, still prices this metal based on its old uses. But the physics demand is about to hit the market like a Category 5 hurricane. We are on the precipice of a sudden, deep, and globally irreversible physical shortage. Let's stop talking chemistry and start talking physics, the physics of scarcity. Even today, before solid-state batteries are mass-produced and enter the supply chain on a massive scale, the market operates at a structural deficit. Global annual demand currently hovers around 1 billion ounces. This figure includes everything: solar power infrastructure, essential industrial uses, high-end electronics, jewelry, and crucial investment demand. But total global supply from mining operations and recycling combined falls dangerously short. We are pulling only about 900 to 950 million ounces out of the ground every year. That leaves an existing pre-SSB structural gap of 150 to 200 million ounces annually. Where does that deficit come from? It is bridged by draining above-ground inventory, the finite reserves held in the vaults of commodity exchanges, refineries, and private hands. This is the first critical truth that Wall Street analysts conveniently ignore. The structural deficit is already here. We are consuming yesterday's savings just to maintain today's status quo. Now, let's add the solid-state battery factor to this already precarious equation. We established that silver moves from a statistical spec to a structural component, requiring substantial volume, hundreds of grams per vehicle. Let's be deeply conservative in our projections. Let's assume that only 30% of global electric vehicle production shifts to this superior, safer battery chemistry by the end of the decade. That single assumption, accounting for passenger and commercial vehicle needs, adds a massive new layer of demand that the system cannot absorb. Analysts conservatively estimate this initial 30% shift will require an additional 250 to 300 million ounces per year. And that, remember, is the conservative figure. If the market is forced to adopt the technology aggressively, say, 60% adoption driven by regulatory mandates and consumer demand for safety, we are instantly talking about an extra 500 to 600 million ounces needed yearly. Stop and run the numbers with me. We are already short 150 million ounces today. If we conservatively add 300 million ounces of new battery demand, the total annual physical shortage explodes to 450 million ounces. That single number represents nearly half of the world's current mining output, and it appears out of nowhere. Demanded by technology that must be adopted. The common refrain from comfortable analysts is always the same: the market will adapt. Recycling will increase, or higher prices will bring new mines online. These are comforting lies divorced entirely from physics and geology. First, recycling offers zero short-term relief. When silver is integrated into the DNA of an EV battery, that silver is sequestered for the vehicle's entire 15 to 20-year lifespan. It's locked away. You cannot recycle what is not yet scrap. The product lifecycle makes immediate relief impossible. Secondly, new mining. Even if the price of silver instantly tripled overnight, a new viable mining operation takes 7 to 15 years to go from discovery to first pour. Geologically, there is no quick fix. Worse, the global average, or grade the concentration of metal in the rock we pull up is in structural decline everywhere. We have to dig up more and more rock just to get the same amount of metal. Wall Street assumes supply is elastic. The physics of the Earth proves it is entirely inelastic. The supply is fixed, the demand is about to explode. This creates a geopolitical paradox. Governments worldwide, backed by trillions in stimulus and regulation, are demanding the transition to electric vehicles. They mandated. But the physics of the Earth, coupled with the immutable chemistry of the solid-state battery, means that the critical element is structurally constrained. This inevitable scarcity will raise the cost of the final product at EV2, a level that makes mass adoption impossible. Crucially, attempts by manufacturers to reduce the required volume of the critical element, a process known as thrifting, will fail. You cannot save money by reducing the necessary amount of the element without reintroducing the fatal flaw: dendrites, fire risk, and slow charging times. The physics of the battery demands it be there. The chemistry is non-negotiable. This is why we have to conclude that the impending scarcity will elevate this element to a category of strategic, national security material. When governments realize they cannot produce the necessary technology without it, they will intervene. This means potential industrial allocation, price controls, and, critically, restrictions on retail or speculative ownership. The state's need for the physical metal will supersede market liberty. This is the reality of the game we are playing. And this terrifying reality is why the current market price, the fake price, being held down by legacy institutions, is the most extraordinary opportunity of our lifetime. Wall Street analysts are paid to read financial statements. They are not paid to read metallurgical reports or understand battery chemistry. Their laziness, their failure to follow the science, is your temporary informational asymmetry. So, how do we act? We need a clear, three-part strategic playbook designed to maximize exposure to the squeeze, while mitigating the risks of government or market intervention. Strategy number 1: maximum physical exposure. In a true industrial squeeze, when global manufacturing capacity demands a fixed input to survive, physical possession is the ultimate form of leverage. But we must be specific. You must avoid what we call the numismatic trap. Numismatics means collectible coins, rare certified assets with premium value tied to their perceived artistic or historical rarity. When industrial fabricators need 1,000,000 kilograms of the critical element tomorrow, they do not care about the coin's artistry, its grade, or its historical value. They only care about its melt value, its gross atomic weight. Therefore, the tactic is simple. Focus relentlessly on low premium, high density, physical bullion bars and basic generic rounds. You are prioritizing the raw weight of the element over the beauty of the design. You must maximize your exposure to the weight of the metal, because that is what the desperate industrial buyer will pay for when the panic hits. Strategy number 2: the right mining stocks. While holding physical is essential, it is a slow vehicle. For explosive financial leverage, we turn to the miners. But here, another trap awaits: the hedge trap. Many major mining companies secure long-term price certainty by selling their production forward, a process called hedging. If the price of the element triples, the company that hedged their supply at the low price receives none of the exponential upside. They protected themselves against the downside, but they crippled their ability to profit from the super cycle. The tactic is therefore to choose primary, unhedged miners. Primary means the vast majority of their revenue comes from this single critical element. Unhedged means they are 100% exposed to the current spot price. Why is this critical? Because of operational leverage. The cost of running a mine is relatively fixed. When the price of the element goes from $20 to $80, the mine's expenses stay almost the same, but the profit margin explodes exponentially. It multiplies many times faster than the spot price itself. That is where true wealth is created. We have covered physical assets and financial leverage. Now, we must talk about the third, equally important filter: geopolitics. In a supercycle driven by essential strategic technology, security of the supply chain becomes paramount. Western governments, especially the United States and the European Union, are extremely sensitive about having their multi-trillion-dollar energy transition plans held hostage to unstable nations or strategic rivals. This reality immediately creates a two-tiered market for the element. You are looking for assets located in what are known as Tier 1 jurisdictions, places like the United States, Canada, Australia, and politically stable parts of Mexico and Peru. These places offer legal stability, low political risk, and crucially, access to Western subsidies and incentives. Think about the massive tax credits being deployed right now that require critical materials to be sourced from North America or allied nations. This legislative push puts a massive premium on what we call clean element material mined under stable Western legal frameworks that guarantees delivery without political interference. Conversely, you must rigorously avoid companies operating in unstable jurisdictions, particularly those with a history of resource nationalism or sudden changes in mining codes. The risk of expropriation, the seizure of assets by a hostile or desperate government, is not theoretical. It is the ultimate zero-sum risk. During a period of acute scarcity, any government controlling a significant reserve knows it holds immense bargaining power. Do not expose your capital to jurisdictions where the rule of law is optional. Security of ownership is as important as security of supply. Now, if this is a technology-driven supercycle, how do we know when the game is over? Every technology-driven supercycle is finite. This is not forever money, it is cyclical money. The time frame we are looking at is roughly 7 to 10 years, the time needed for full global industrial adoption of the solid-state battery, the necessary market catch-up, and the eventual development of a true technological successor. The moment the initial demand explosion starts, the world's greatest engineers and chemists immediately start working overtime to neutralize this newfound scarcity. So, what is your exit signal? It is not the price. The price is noise and volatility. The exit signal is technological obsolescence. The moment a viable, scalable, and safe battery, chemistry perhaps, sodium-ion, or a highly advanced graphite solution comes to market that successfully removes our critical element from the structural DNA of the solid-state battery, the game ends. That technological breakthrough would immediately neutralize the scarcity premise. Until that day, as long as the laws of physics require this element to contain the fatal flaw of dendrites and ensure stability and rapid charging, the scarcity thesis holds, and the price will be driven by desperate industry demand, not by speculative paper traders. We have established the thesis, the structural demand explosion, and the playbook for entry and exit. But the truth is, none of this matters if you cannot withstand the psychological warfare that is coming next. We are entering Module 4, the psychological war and the market open. We have established the thesis, the structural demand explosion, and the playbook for entry and exit. But the truth is, none of this matters if you cannot withstand the psychological warfare that is coming next. We are now entering the final module, the psychological war and the market open, right now. As you watch the screen, the price of our critical element in the West, the price you see on your terminal, is a lie. It is the price of paper promises traded on the COMEX, driven by high-frequency algorithms and bank short positions. It reflects an artificial reality, designed to scare weak hands into selling their physical exposure. But there is an arbiter, there is a mechanism that prevents the Western banks from pushing this price to zero, no matter how much paper they dump. That mechanism is called the Shanghai Gold Exchange, or the SGE. The West trades paper. The East demands and consumes physical metal. The world's real industrial demand is priced in Shanghai, and they buy what they need to manufacture the essential components we discussed. If the price in London and New York falls too far below the industrial price in Shanghai, a risk-free profit opportunity opens up, and global traders cannot resist it. Here is the simple, physical equation. If the COMEX paper price is artificially suppressed to, say, $20, but the true cost to buy, ship, insure, and deliver a physical bar of that element into an industrial vault in Asia is $30. Every smart arbitrage trader in the world jumps in. They buy the cheap paper contract on the COMEX, they immediately stand for physical delivery, they secure the actual bar, they ship it to Shanghai, and they sell it for a massive, guaranteed profit. This is the great self-correction mechanism of the physical market. Every time traders exploit this arbitrage, they do two things. They drain the visible inventories out of the Western vaults, and they force the price of the paper contract to rise instantly to close the gap. The metal physically moves from the jurisdiction of speculation to the jurisdiction of industrial necessity. When the market reopens on Sunday evening or Monday morning, the market mechanics will be simple and brutal. The market will open with a gap up, a sudden jump that nullifies most of the induced volatility we just witnessed. This gap up is not sentiment, it is mathematics. It is the arbitrage traders closing the Western paper price gap to the Eastern physical price reality. Once they have used their tools of price suppression, and the fundamentals immediately negate their move, the banks only have one weapon left: volatility. Their goal now is not necessarily to lower the price forever, but to inflict motion sickness on investors. They want to create such violent, sudden price swings that you question your thesis, you panic sell out of sheer exhaustion, and you miss the inevitable climb. The only way to defend against this final psychological attack is to ignore the daily price noise entirely. The price on your screen is irrelevant volatility. Ignore the noise, focus on the scarcity. The physics always wins. We have established the industrial scarcity. We have proven why the physics of the solid-state battery mandate the use of this critical element, and why the supply is totally inelastic over the timeline that matters. Now we must transition to the ultimate consequence of this inelastic scarcity, the macroeconomic impact that forces central banks into action. This is the $1 trillion checkmate that forces the Federal Reserve to print money. This profound chemical scarcity is not merely an investment opportunity. It is a fundamental political and economic challenge to the global order. Look at the current political landscape. Governments in the United States, Europe, and Asia have spent trillions, and I mean trillions, subsidizing and legislating the energy transition. They have passed hard laws demanding the transition to electric vehicles, setting hard deadlines for the phase-out of fossil fuels. This transition is not a preference. It is an immovable political objective. It is the defining legislative priority of the decade. Now, picture the fallout if that entire trillion-dollar global initiative stalls. It stalls not because of consumer apathy, but because of a physical shortage of one single, essential element required to make the next generation of power generation and storage work. The political consequences of failure would be catastrophic. The government cannot, and will not, allow their defining mandate to fail because the free market was unable to deliver the necessary raw materials. This is the tipping point where the state intervenes. If the current market price is insufficient to incentivize the high-cost, high-risk mining needed, which we have shown it is not, due to geological limits and/or grade decline, the government has only two choices. Choice A. They do not tax their way there, they print their way there. This is the mechanism that forces the Fed's hand. The geopolitical and legislative mandate demands the material. If the market cannot deliver it, the state must. And when the state must deliver massive inelastic supply in a compressed timeline, the result is massive monetary injection, inflation, and a checkmate on the central bank's ability to control the money supply. The moment this strategic element is officially designated a national security resource, and, make no mistake, that process is already underway, the price mechanism shifts entirely. It moves from simple supply and demand economics to necessity and defense, and the price of necessity, when backed by the full faith and credit of a sovereign state, is always exponentially higher than the price of mere profit. We are not just witnessing a commodity super cycle, we are witnessing the forced financialization of industrial security that forces the Fed to inject liquidity, driving the entire physical reality of this industrial squeeze far past anything currently priced in by Wall Street. The forced financialization of industrial security drives the entire physical reality of this industrial squeeze far past anything currently priced in by Wall Street. But how does that reality translate back into the price you see when the Western trading week opens? Right now, the battlefield is simple: the price of paper versus the price of physics. Wall Street and the major bullion banks control the paper game, the contracts traded on the COMEX, but the physics game, the immediate, overwhelming demand for tangible metal, is centered squarely in the East. Specifically, we are talking about the Shanghai Gold Exchange, the S. When the paper price, the price you see flickering on your screens, aggressively suppressed, while the physical reality, the premiums being paid for bars and wafers in Asia, remains high, it creates what is known as an arbitrage loop. This is a risk-free profit up. This arbitrage loop functions as an instant non-negotiable pricing mechanism. It doesn't care about Fed announcements, CPI numbers, or what Jim Cramer said on TV. It only cares about the physical gap, and that gap must be closed. This is why we can forecast with high confidence that any intentional price drop engineered during weak liquidity hours like late Friday or Sunday night will be instantly denied. The market will be forced into a massive gap up on the Monday open as the arbitrage mechanism slams the COMEX price violently upward to meet the reality of Asian physical demand. They know this reality. They know the physics will eventually win. So, what is their last remaining weapon against you? Psychological warfare. It is called the shakeout, and it relies entirely on inducing motion sickness. Since they can no longer control the supply fundamentals, the chemistry is immutable, the scarcity is locked, and their only remaining hope is to control your emotional state. They inject extreme, nerve-wracking volatility into the market, massive $2 or $3 swings up and down multiple times a day to make you feel insecure, stressed, and frantic. They want you to panic sell your position right before the market realizes the geopolitical checkmate is complete. This is the final test of conviction. You must recognize this noise for what it is: a desperate distraction. Your defense against the shakeout is to ignore the daily COMEX price tick. It is a manipulated, fractional indicator. Your focus must be fixed exclusively on two immutable indicators. First, the premiums being paid for physical product globally, and second, the actual inventory levels in the global exchange vaults. The paper price can be engineered. The physical reality of scarcity and industrial desperation cannot hold the line. The game you are playing right now is not about timing a chart or trying to predict the next analyst downgrade. This is a game of paper versus physics. For decades, the banking institutions have dominated the paper game. They have used leverage, derivatives, and algorithmic timing to suppress the price of physical assets, allowing them to accumulate real wealth while selling us synthetic exposure. That era is definitively over. The paper game is finite, vulnerable to audit, and ultimately reliant on confidence. The physics game is immutable, dictated by the periodic table, and driven by trillion-dollar mandates that cannot be ignored. We are betting on the fact that you cannot defy chemistry. You cannot invent around the necessity of the element critical for the solid-state battery. You cannot fast-track a decade-long mine permit, and you certainly cannot recycle what hasn't been used yet. The global industrial system requires this metal to maintain its energy transition timeline. If the supply chain stalls and our modeling shows absolute scarcity, arriving much faster than analysts project, the geopolitical pressure becomes unbearable. Think about the implications of the checkmate in our title. When Japan blocks key chip exports, or when critical materials vanish, global supply chains break. When supply chains break, governments have two choices: abandon their transition goals, which leads to political suicide and catastrophic economic instability, or intervene directly, stabilizing the market and subsidizing the necessary cost of the material. Intervention, stabilization, subsidization, these are all synonyms for the Federal Reserve being forced to enter the market and print money to cover the gap between the paper price and the true cost of industrial adoption. This is the $1 trillion guarantee that makes this thesis foolproof. We have done the math on the geological deficit. We have proven the inelasticity of industrial demand. We have isolated the mechanism, the Shanghai arbitrage, that instantaneously corrects the fraudulent paper price. And we have identified the psychological warfare being deployed right now to scare you out of your position. The price glitch you are witnessing, the one Wall Street insists, is temporary. Is the last chance for the smart money to acquire maximum exposure before the reality of solid-state battery demand fully hits the market. When the physics inevitably takes over, the asset you hold will instantly transition in the market's eyes from an investment commodity to a core strategic national resource. When that happens, the price discovery process stops being rational and starts reflecting pure panic, driven by the world's largest industrial consumers and sovereign states racing to secure the last available tons. Do not let yourself be shaken out now. Do not trade volatility, trade conviction, trade the physics. This entire narrative, the geopolitical maneuvering, the technological necessity, and the market suppression was designed to deliver you this precise window of asymmetric opportunity. Hold the line, because the final piece of this checkmate is the absolute, guaranteed leverage we gain when the central banks are forced to pivot and validate our entire thesis. That pivot is closer than anyone imagines. We have detailed the chemistry, the geology, and the market suppression required to deliver you this opportunity. But we must now elevate our view one final time, from the mechanics of the market to the inevitable response of the nation-state, because that response is the guaranteed pivot that validates our entire investment thesis. When Japan or any major industrial power blocks exports of critical inputs, be it advanced chips, specialized metals, or key components, it is not merely an inconvenience, it is the final signal that the 50-year era of seamless low-cost global supply chains is dead. It is the signal that the world is moving from a system based on efficiency to one based on redundancy and security. This is the geopolitical checkmate. The central banks and governments of the West cannot function in a world where industrial capacity is held hostage by strategic competitors or by the simple, brutal reality of geological scarcity. The technological necessity of the solid-state battery combined with the sudden recognition of critical resource scarcity of the silver forces a political response. When industrial production begins to choke, when automakers cannot source the chips, when renewable energy grids cannot scale due to battery limitations, and when the core strategic materials become unobtainable at any rational price, the government's mandate shifts instantly from managing inflation to preventing systemic industrial collapse. They cannot fix a supply-side crisis by raising interest rates. That only destroys demand and ensures a deep, painful recession. Their only tool remaining, their only political answer, is to ensure the system survives by any means necessary. And that means only one thing: injecting liquidity into the economy to subsidize the desperate race for these materials. They will fund the expansion of domestic mining. They will fund the construction of gigafactories. They will fund the strategic national stockpiles. They will print the money required to secure the supply. This money printing is not an option. It is an absolute political certainty. It is the final, guaranteed source of inflation that will launch this industrial commodity supercycle into its terminal phase. This is the moment where the value stored in hard assets, particularly those essential for the mandatory energy transition, completely decouples from the perceived value of depreciating paper currencies. The crisis is reaching its peak convergence right now. They can deploy every weapon in the psychological warfare arsenal: extreme volatility, coordinated attacks on the paper price, non-stop negative media coverage, but they cannot change the laws of physics. They cannot create new silver on demand. They cannot uninvent the solid-state battery. Do not allow the final, violent whipsaws of the paper market to shake you out. Ignore the noise. Focus on the geometry of the situation. We have scarcity, we have inelastic demand, mandated by governments, and we have the guarantee of massive money printing as the political solution to the industrial supply crisis. We have secured the position. We understand the technology, we understand the politics, and we understand the printing press. Hold the line. The checkmate is complete.